Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to Equity Mates, the podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. My name is Bryce, and today we have a jam-packed show. We're getting an update on the latest inflation and interest rate numbers. We're looking at Australia's Dividend Darlings and a community question on how to find quality information. To chat through it, as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We have a lot to cover. But before we get into it, I want to share my gripe with the English language.
Okay. Because
some breaking news this morning that I saw in my podcast feed, not related to finance.
Okay.
Swans golden boy Errol Goulden resigns. ...
What?
And my heart was in my mouth and it was not good. It was actually re-signed. But I'm making the call out that we need to put a hyphen between re and signs.
Definitely.
Because those two things mean very, very
Definitely.
different. Yeah.
Was it a GR?
No, it's just spelt the same.
No, re-sign definitely has a hyphen.
A hyphen.
Yeah.
Yeah, well...
Like, what I'm saying is it an intentional
No,
misuse of the hyphen
it wasn't like
get
this,
a click?
It wasn't like this footy podcast was like trying to G up all the Swans fans out there to get a click.
What was the podcast?
It was Fox Footy.
Okay.
Yeah.
Well, okay. They'd make that sort of mistake.
Yeah, well, that's what, it's a mistake more, yeah. Anyway,
wow.
My opening gripe is with the English language this morning, but great news that Errol Goulden's re-signed.
Great news, yes.
All right, finance, let's go.
All right, well, let's kick into it.
News and markets.
Ren, I want to kick off with a fun fact that I didn't know. In a recent court filing that Meta had to file for part of their FTC case, it came to light that Instagram in 2021 made more revenue than YouTube. So Instagram made $31 billion, 31.4 in 2021. YouTube made $28 billion. They don't have recent figures for Instagram. You can only assume it's gone up since then. I think at the moment YouTube is making about $31 billion in 2023. I found that fascinating.
Yeah, I found that interesting but not surprising. Like, if you had asked me point blank which made more money, I think I probably would have said Instagram.
Oh, wow. I would have definitely gone YouTube.
I've just had a look. YouTube has 2.7 billion monthly active users. Instagram has 2 billion monthly active users. So YouTube is bigger.
And I would have assumed time spent on platform more on YouTube as well.
Yeah, you'd think so. Yeah.
So I guess if someone were to say to me you had to choose one over the other, I would have hands down gone YouTube.
Yeah.
But I think amazing. And they're now doing money in advertising in Reels that's even come up through our business as well, so making more money that way, I think.
Yeah, I think it's like, even though YouTube has more monthly active users and longer time on site, Instagram would probably have more, not even daily active users, but like hourly active users, if where I'm going makes sense. It's like people are just constantly mindlessly opening their phone and opening Instagram.
I also just think how we look at both channels from a media advertising point of view and where our ad dollars go across both channels, and like it's Instagram, we spend more on advertising than we do YouTube. The ability to boost posts and that sort of stuff. So anyway,
actually, here you go. So I've just Googled it. So even though YouTube has more monthly active users, daily active users, these are, I think, both approximate. YouTube has approximately 122 million daily actives, whereas Instagram has 500 million daily actives.
Right.
So
okay.
like you can see there the dynamic between the monthlies and the dailies.
Yeah.
Look, to be honest, the only takeaway from here is that both of these platforms make stupid amounts of money.
Well, yeah, so it's 30% of Meta's total revenue, apparently.
Yeah. Honestly, I'm surprised it's not more. Like, how is Facebook earning more money than Instagram these days?
Well, apparently we know from the share price, it's up 5-fold since the bottom of 20.
No, I'm just saying from like a relative engagement and user-based point of view. Like, it feels like the fact that Facebook.com is making more than Instagram is crazy.
Yeah, well, yeah. Anyway, fun fact.
Fun fact.
Apparently Zuck's killing it at the moment with what he's doing with AI and the ability for advertisers to now target, and the spend effectiveness of spend on Facebook is apparently now going through the roof again. So
I'll believe it when I see it.
Well, the share price is definitely reflecting that.
But I mean, like, we've experienced firsthand I
think there's a bit of user input that needs to go into it. So we'll leave it there.
Well, if AI and all that is meant to make it great, then it should be easy for users.
Anyway, let's move on. I said at the top we'd be looking at latest inflation and interest rates. Overnight, US inflation data came in hotter than expected at 3.5%. All I think we should say, Ren, is that our calls on interest rates that you made last year and that I made at the start of this year look to be even getting more and more likely. You made the bold call in October or wherever it was late last year that there would be no interest rate cuts at all in 2024. I had a bold prediction that we might see an increase in interest rates in 2024, and it looks like it might be heading that way.
In the US,
In the US. Biden's come out and said that there is more to do. The inflation numbers are certainly not where they want it to be. Former Treasury Secretary Larry Summers said that we need to now take seriously the next rate cut will be up, not down.
It's a confusing quote, that one. The next rate cut will be up, not down. The next rate move will be up, not down.
Next rate move. Did I say
You don't have to apologise. That's the quote. At least it's the quote in the document. Yeah.
Yeah, so I guess the takeaway here is that sentiment is quickly changing. I think only a matter of months ago, markets were still betting that there were going to be multiple rate cuts from June. The Fed board is now predicting that that's not going to be the case. The US economy is hot. Inflation is not slowing as much as it should be. Oil prices are rising. And other commodities are at all-time highs. We've spoken about cocoa, but coffee, copper, gold, aluminium, all input costs, and we know what happens when input costs are high. It contributes to persistent inflation. So, yeah, the picture is somewhat turning.
Yeah, I think it's just that there was too much optimism earlier in the year that, like, we were through the worst of it. And it's like, we are definitely through the worst of it. Like, let's not get it twisted. Some of the inflation numbers that we were seeing 12, 18 months ago, we're not returning to. But it's just like, getting through the last of it is going to be the most difficult. And getting a 3.5 to a 2.5 is going to take some time. And unfortunately, you know, like, most of what you spoke about there was American, but the commodity price story is a global story, and that's going to affect inflation here at home. But a key driver in the CPI bucket is housing.
Yes.
And unfortunately, that is going to be a real... What's the opposite of an anchor? Like a balloon on the inflation number. You know, when it's like...
Yeah, it's an unnecessary... Yeah, it's like a... Yeah.
Yeah, it's an anchor is something that is just constantly dragging it down. This is something that's constantly keeping it inflated.
Yeah.
Because housing and rental costs are just stupidly high and don't really show signs of getting better. There were pretty soft building approval numbers recently. According to NAB, they were the lowest since 2013. We spoke to Sam Gordon a couple of weeks ago on the podcast. You can go and listen to that episode, and we just basically asked him what the hell is going on with property. But it's like more and more builders are falling over, and, you know, no one really wants to take a lot of building projects, or they just don't have the staff to take on those projects. So there are big lofty goals about building our way out of this housing crisis and bringing price down by getting more supply online. Doesn't really seem to happen if we don't have the people and the companies to build. And so that's going to be the balloon on the inflation number here.
Yeah. So if you were factoring in some rate cuts this year, maybe hold your horses. From my point of view, doesn't change anything for me when it comes to investing approach. Just keep buying. Markets won't like this. The froth is starting to come out a little bit. We've been going in a left to right direction since late October last year. And the markets are now, I guess, readjusting expectations that we're going to have fewer rate cuts. So just keep buying. I think you can lose a lot of sleep and a lot of hair worrying about what's going to happen in the macro economy. But as we keep saying, like, you can't time the market, so just get into the market and
you'll be okay over the long term.
So, Ren, I said at the top as well that we're going to be looking at Australian dividend darlings.
Yes.
Companies that have been consistently paying dividends. So what have you got?
Well, I want to start by introducing the concept of the Dividend Aristocrats. Are you familiar with this concept?
I am. Companies that continuously increase dividends year after year.
So specifically, like the technical definition is companies in America's S&P 500 that have raised dividends for 25 years or more.
Raised dividends for
not
25 years or more.
Not even raised or kept steady.
But just flat out raised.
Raised dividends for 25 years or more. And if you fall out of the S&P 500 or you don't raise your dividend,
you're gone.
You're gone. So that's the technical criteria for the Dividend Aristocrats.
Okay.
How many companies in do you think fit that criteria?
In the States?
Well, the S&P 500 is the States, yeah.
8.
No, 67.
Oh, wow.
Yeah, I know. It's heaps. And there's, some really well-known companies. It's a lot of the quite boring companies. It's like the 3Ms of the world, and it's like Coke's in there and stuff like that. So there are ETFs that buy these Dividend Aristocrats. So like track the Dividend Aristocrats. The index over the last 5 years has returned 43%, 44%. So not bad.
Year on year?
No, over the 5 years. Yeah. And so it got me wondering, is there an Australian version? And I'm calling these the Dividend Darlings rather than the Dividend Aristocrats. So what I did was I jumped onto Ticker and used their stock screener. Anyone can jump onto ticker.com/equitymates. The link will be in the show notes. But all I did was, rather than 25 years, I started with just 10 years.
Yeah.
And I just said, any company on the ASX, and then I did, has increased their dividend per share more than 0% for the last 10 financial years.
Yeah.
How many companies, so not ASX 200, just total ASX, all 2,000 Aussie stocks, how many companies do you reckon fit that criteria?
10.
Pretty close, 12.
Okay.
Yeah. Then I changed the inputs to have raised or kept steady for the last...
Yes, yeah. So not going backwards.
Yeah, not going backwards.
Yeah.
How many companies do you think fit that criteria?
So not going backwards, maybe 40.
Exactly 40.
Oh, nice.
Yeah. But I want to focus on the 12 because that's a lot easier to talk about on a podcast than the 40. Some of the companies that you would expect to be in here, like you would think like BHP, Rio, like they're the Dividend Darlings.
I know
the banks.
2 that would be in there.
Name them.
Soul Pats.
Yes, Washington H. Soul Patterson.
And Brickworks.
Brickworks, nailed it. That's 2 of the 12. Yeah. So in order of largest market cap to smallest market cap, Sonic Healthcare.
Okay.
Car Group, which is what car sales have changed their name to.
Okay.
Yeah. Soul Pats, as you mentioned. APA Group. One that's about to come off the board, Altium Limited, because it got bought out, so it's not going to be listed anymore. Charter Hall Group, the property developers. Technology One. Brickworks, you mentioned. Centuria. Arena REIT, and then 2 more, Nick Scali Furniture.
No way.
Yeah, and Fiducian Group. So that list was a little surprising to me.
Yeah, Nick Scali surprises me. I don't know why. It just doesn't feel like it fits in with those other... How long was this? Over 15 years?
No, 10 years. 10 years. So the Dividend Aristocrats in the US are 25, but after 10 years, I only had 12 stocks. So I figured let's leave it there. The Nick Scali story is a fascinating story. Like, look at
the share
price over the last 10 years.
Yeah.
I mean, it's 10 bags since it listed.
Yeah.
But since 2014, it's gone from $2 to $15.
Yeah.
It's crazy.
Killed it.
Furniture.
Yeah.
So those are the 12 companies that I'm naming Australia's Dividend Darlings.
Okay.
The question then becomes, how has it performed as an index cluster, as a group?
Yeah.
Do you want to have a guess? I did the last 10 years.
Over the last 10 years, those companies. I mean, so it's got some good ones in there. The Nick Scalis have had some pretty incredible run up in price over the last 10 years. The Brickworks, consistent over the last 10 years. I'm going to say Over 100%.
No, so I've got the per year returns.
Oh, per annum.
Yeah.
Scheißen. Okay. Ooh. ASX. Probably 15% a year.
Okay, so I went onto ShareSite and I don't pay for it, so I could only put 10 of the 12 stocks in.
And let me guess, you chose the top 10 best
So
performers.
I took Nick Scali and Fiducian as the two smallest market cap companies got the flick.
Okay.
And of the 10 that I could put in ShareSite for free, the per annum return was 55% a year at compound average annual growth rate.
Obviously includes dividends.
Includes dividends. But then skewing that number was Altium. Altium went from like $2 over the last 10 years, went from like $2 to $65 a share.
Okay.
So then I did X Altium. So I flicked Altium out and put Nick Scali back in.
Yes.
And the numbers, as I look at them on ShareSite, 29% per annum return. And that's made up of 18% capital gain and 10% dividend
Solid.
yield. Yeah.
Solid. So what's the takeaway here?
Well-
Go the index.
It's just, I mean, like the Australian Dividend Darlings have done much better than the US Dividend Aristocrats. So that's a starting point. But I think it's just a good
over different time periods.
over different time periods. Yeah. But this Dividend Aristocrats ETF I'm looking at listed in 2013.
Okay.
So I'll even give them the extra year because they're 141%.
Okay.
Not per year, but over the 10 years.
Total, yeah.
So we've kicked their ass.
Yeah. Nice.
Unsurprisingly, a factor that is a positive indicator for stocks is a company that is consistently raising their dividend. And this just is testament to that.
I have a slightly controversial opinion.
Hit me.
Some of them do it to have the bragging rights.
Definitely. And to get into the Equity Mates Dividend Darlings ETF coming to market 2025.
Like, do you want a company that you're invested in to consistently raise dividends for the sake of it?
Cut the last 3 words of that, or the last 5 words of that. Do you want a company that you're invested in to consistently raise dividends?
That's not my point, though. For the sake of it. Yes, for a PR stunt. And I'm not naming which companies are in there that I think are doing it for a PR stunt, but I think there would be a bit of pressure on some of them because they do pride themselves on it.
Yeah, I think that's certainly a factor. I think especially in the US, if you're a CEO of a company in the Dividend Aristocrat Index and you've had 25 plus years of dividend growth, you wouldn't want to be the CEO that cuts it.
No.
But like it's interesting. I'll include just the link to the Wikipedia page in the show notes because it has a list of all the 67 companies. There's some really well-known ones, but it also has a history of how companies fell out.
Okay.
And, it's obviously like around 2020 and 2008, like when the market crashes and companies get in trouble, that's when you see a lot more companies having to make that hard decision to cut their dividend. But yeah, some big companies were in it and went through some tough times and got the flick.
Nice. Well, there you go. The ASX Dividend Darlings.
ASX Dividend Darlings. Yeah.
Loved it. All right. Well, we're going to take a quick break, and on the other side, we've got a community question coming in from Greg. So stick with us. We'll be right back. Welcome back to Equity Mates. It is time for...
Let's ask the community.
Equity Mates.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Questions.
This week's question has come in from Greg, so let's give it a listen.
Morning, legends. Just listened to your latest podcast, and one question I do have is when you were speaking to Luke about if you get your information from the internet, it's too late. Apart from the Fin Review and reading some of the older books on investing, where else would you be getting up-to-date information? Me being a newbie who, after listening to your podcast for a while now, is possibly not investing but gambling. I am holding like the longevity. It is 5-10 year plan for me and my wife. So yeah, just on the information, like where can we get up to date information? Thanks, guys.
Thanks for your question, Greg, and thanks for the support, listening to the show. We really appreciate it. So, where to start? Listening to that, I think he's feeling, obviously, like some of the comments Luke made, which were fair.
To be honest, I think I actually made that comment about once the information's in on the internet, it's known. So I think for me, when we say like once the information's on the internet, it's priced in, it's because the market moves so quickly now, and there are so many market participants that are, as soon as news breaks, there's algorithms or there's people that are trading. The information flows so quickly through the market that once we're reading it on the AFR or, whatever news website we use, the market has reacted to that news.
Yeah.
Gone are the days where you
Buffett era.
Yeah, the Buffett era where you could find a gem of information and just by reading the paper and investing in it a day or two later or a week later or whatever. Those days are gone. But that doesn't mean you can't be a successful stock picker. But the edge that you have and how you make money as an investor in individual stocks doesn't come from having information that other people don't have, but it comes from having the analytical ability or insight that other people don't have.
Like your own analytical ability.
It's like
you creating your thesis.
The market reacts to information quickly, but you think, the way that they've reacted is incorrect. Like they don't understand what Caterpillar are actually doing and what that information actually means or how that will affect this company or that company. So when we say that like the information is known, it's just like the way that you have to think if you want to be a stock picker.
Yeah.
And that's the important caveat here, because a lot of people make a lot of money not being a stock picker, and it's like a perfectly good choice. It's just like, don't think that you've found a piece of information online that no one else has found.
Impossible.
Because by definition, if you're finding it online, someone's published it.
Yeah.
And chances are that by the time it was published, a whole bunch of funds have acted
on it. Yeah.
Like the extent to that hedge funds go to get proprietary information now is just wild. Like, satellite imaging of car parks above factories to then try and forecast the amount of business that factory is doing based on the amount of staff that are being called into that factory. Like it is just like, or satellite images of like train carriages and how full they are, or the idea that by the time we're reading something online, it's not known by the market. Forget it.
Game over.
Yeah.
Don't let that discourage you, though, Greg. I think the point is there is no source of information that we're using or that Luke's using that is going to be that, I guess, first piece of information that no one knows about. I think to Ren's point, if you're interested in individual stock picking, the information is, there's so much information now available for you to form your own thesis and decide whether what the market has determined is right or wrong. And
all of the best examples of stock picking recently are not examples of people getting new information before the rest of the market. Like just the companies that come to mind are companies where the market thought the growth was already priced in, and those that made money thought the market is wrong and underestimating what's happening here, Nvidia and Novo Nordisk. And then on the other side, the other one I'm thinking of is Meta, where
I was gonna say,
all the information is flowing into the market is reacting, and sentiment becomes more and more negative. And those that made money said, hold on, the market is missing the forest for the trees here, and they're reacting to this new information rather than what has been known forever, which is that these are dominant companies that just print cash. And then again, it was the stock pickers that had the insight that made money.
Yeah.
So don't be discouraged by by what we're saying here, because it's like, it's not how you make money. How you make money is analyzing these companies and thinking differently about these companies. And we can all do that.
Love it. Well, Greg, I hope that answers your question.
Hold on. Did Greg also ask where we get information?
He said, like, what's the go-to source? Like, if for that, I guess the question was more like, is there this source where you can go to get this like
up to date,
hot off the press.
No, I think there's no, in terms of where you get information, there's no perfect source. Like if you're reading the financial news, if you're reading company reports, and if you're using a data source like a ticker or something to get financial information, there's really nothing. There's no secret source out there.
Yeah. Speaking of, we've mentioned a number of platforms in today's episode. Ren spoke about ShareSite, which is a great tool for tracking your investment portfolio. Ren has the free. I pay for mine. I think it's well worth it. So if you want to go to sharesite.com.au/equitymates, there's an offer for you there if you want to sign up. And similarly, Ticker, which is the financial stock screener that we use globally, head to ticker.com/equitymates. We'll put both
links
in the
will
show
be in the
notes.
show notes. Yeah.
But if you want to ask a question, just head to equitymates.com/contact. All the information is there for you to submit a question for both us or any of the financial advisors that come on the show. But Ren, as always, pleasure to chat stocks, and we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.